Why you're getting poorer every year. You're working harder, earning more on paper, yet somehow you're falling behind. Your paycheck shows bigger numbers than 5 years ago, but that grocery bill that used to be manageable now makes you wince. The rent or mortgage that felt reasonable has become a monthly struggle. And that retirement account you've been faithfully contributing to? It's not growing the way you thought it would. Here's the uncomfortable truth. There's an invisible force draining your wealth every single day, and most Americans don't even realize it's happening. It's called the silent tax, and unlike the deductions you see on your pay stub, this one operates in the shadows quietly, relentlessly, and legally stealing your purchasing power. Let's start with what this silent tax actually is. Economists call it inflation, but that clinical term doesn't capture the real damage it inflicts on your life. Think of it this way. Inflation is what happens when the same dollar in your pocket buys less today than it did yesterday. Between January 2021 and mid-2025, prices in America have climbed over 22%. That means if you had $1,000 saved at the start of 2021, that same $1,000 now has the purchasing power of roughly $770. You didn't spend a dime of it, yet you lost more than $200 in real value. No legislation was passed. No tax form was filed. The money simply evaporated from your savings while you slept. And here's the kicker. This isn't some temporary glitch in the system. It's a feature, not a bug. The mechanics of how this silent tax works are surprisingly straightforward. Yet most people never connect the dots. When the government spends more money than it collects in taxes, it has two choices: borrow or print. In recent years, particularly during the pandemic response, the U.S. government chose both options aggressively. More than $5 trillion in pandemic-related spending was financed almost entirely through debt and money creation, not higher taxes. Compare that to major wars in American history, where at least 20 to 30% of spending was covered by explicit tax increases. But printing money without a corresponding increase in actual goods and services creates a predictable outcome. More dollars chase the same amount of stuff, and prices rise. When the Federal Reserve creates money out of thin air to purchase Treasury bonds, it's not some abstract financial maneuver. It's directly connected to why your dollar doesn't stretch as far as it used to. Now let's talk about something tax experts call bracket creep, because this is where the silent tax gets truly insidious. Here's how it works. Imagine you're earning $50,000 a year, and inflation causes prices to rise by 5%. Your employer, trying to be fair, gives you a 5% raise to help you keep up. Congratulations, you now earn $52,500. Except there's a problem. The tax brackets, those income thresholds that determine how much you pay in federal taxes, often don't adjust quickly enough or fully enough for inflation. So that raise that was supposed to help you tread water against rising prices, a bigger chunk of it gets taxed at a higher rate. You're pushed into a higher tax bracket not because you're actually earning more in real terms, but simply because inflation inflated your nominal income. The result is fiscal drag. Your take-home pay in real terms, what you can actually buy, shrinks even though your gross pay went up. Studies from 2024 and 2025 show this phenomenon hit Americans particularly hard during the recent inflation surge, with lower and middle-income households bearing the heaviest burden. The numbers tell a sobering story about who really pays this silent tax. Research from the Congressional Budget Office reveals that lower-income households face disproportionately higher effective inflation rates than wealthy households. Why? Because poor and middle-class families spend a much larger percentage of their income on essentials, food, rent, gasoline, utilities, all categories where prices have spiked hardest. When egg prices double or rent jumps 15% in a year, it devastates a family living paycheck to paycheck. Meanwhile, wealthier households, who spend proportionally less on essentials and more on discretionary items, feel less pain. Even more striking, some middle-class and wealthy households actually benefit from inflation. How? If you own a home with a fixed-rate mortgage, inflation gradually reduces what you owe in real terms. If you hold stocks or real estate, those assets often rise in value during inflationary periods. But if you're a renter scraping by, inflation offers no silver lining. You're just getting poorer month after month. with no assets appreciating to offset the damage. Let's examine what happened to American wages during the recent inflation surge, because this is where the rubber meets the road for most families. From early 2021 through 2023, the United States experienced something economists hadn't seen in 40 years. Inflation consistently outpacing wage growth for 25 consecutive months. Think about that. For more than 2 years straight, prices rose faster than paychecks. During the peak in June 2022, inflation hit 9.1%, while wages increased only about 4.8%, a gap of more than 4 percentage points. Recent data from 2024 and 2025 shows wage growth has finally started outpacing inflation again. But here's the problem. You can't make up lost ground overnight. Even with wages now growing faster than prices, Bureau of Labor Statistics data reveals that real hourly earnings are still down about 0.7% compared to early 2021. Translation: the average American worker can buy less with their paycheck today than they could 4 years ago, despite getting several raises in between. The silent tax took its cut, and most people never realized they were being robbed. Savers and retirees face perhaps the cruelest version of this silent tax. Imagine you've spent 40 years diligently saving for retirement. You've done everything right, contributed to your 401k, built an emergency fund, avoided debt. You retire with $500,000 saved, thinking you're set. But here's the brutal math. If inflation runs at just 3% per year and your savings account pays 2% interest, you're losing 1% of purchasing power annually. Doesn't sound like much? Over 20 years, that seemingly small gap compounds into a devastating loss. Your $500,000 will have the purchasing power of roughly $410,000 2 decades later, even though the nominal number on your bank statement barely budged. For retirees on fixed pensions without cost of living adjustments, the situation is even worse. A pension that seemed comfortable at 65 becomes inadequate by 75, forcing retirees to drain savings faster than planned or make painful lifestyle cuts. Social Security includes cost of living adjustments, but those adjustments often lag behind the actual inflation retirees experience, especially in categories like healthcare and housing, where costs for seniors rise faster than average. The government itself benefits enormously from this silent tax, which partially explains why meaningful action to stop it remains elusive. When inflation runs hot, tax revenues surge without Congress passing a single new tax law. How? First, bracket creep pushes more taxpayers into higher brackets, as we discussed. Second, wages rise nominally, even if they're stagnant in real terms, generating more income tax revenue. Third, sales tax and value-added tax revenues climb automatically as prices increase. Some researchers analyzing data from 2024 estimate that bracket creep alone generated over $1 billion in additional federal tax revenue from American taxpayers' money collected without any vote, any debate, or any accountability. Meanwhile, inflation also helps governments manage their debt burden. If the federal government owes $10 trillion today and inflation runs at 5% for several years, that debt becomes easier to repay in real terms. The government is essentially paying back creditors with cheaper dollars. It's a clever trick, and taxpayers foot the bill. Let's address a question you might be asking. But haven't some experts said wages are actually keeping up with inflation now? The answer is complicated and depends heavily on how you measure and what time frame you examine. Data from mid-2025 shows that wage growth has indeed exceeded inflation for more than a year, offering some relief. Bureau of Labor Statistics figures indicate that from July 2024 to July 2025, nominal wages increased 4.2%, while inflation ran at 2.7%, a positive gap of 1.5 percentage points. That's genuinely good news and suggests purchasing power is slowly recovering. However, zooming out to the full pandemic era paints a different picture. From the start of 2021 through mid-2025, cumulative price increases have outpaced cumulative wage growth, leaving real earnings still underwater for the average worker. Additionally, aggregate statistics hide enormous variation. Some workers, particularly those in tight labor markets or unionized industries, have seen solid real wage gains. Others, especially those on fixed incomes, minimum wage workers in states without increases, or those who couldn't switch jobs during the labor shortage, have fallen further behind. The average experience masks profound inequality in who bears the burden of this silent tax. So, what can you actually do to protect yourself from this silent tax? The unfortunate reality is that individuals have limited power to stop inflation itself. That's a macroeconomic policy issue requiring government action. But you can take defensive measures to minimize the damage to your personal finances. First, understand that keeping substantial savings in regular bank accounts or under your mattress is effectively volunteering to pay the silent tax at its highest rate. When savings account interest rates hover around 1 or 2%, while inflation runs at 3 or 4%, you're guaranteeing losses. Financial experts consistently recommend that long-term savings should be invested in assets that historically outpace inflation. Stocks, real estate, inflation, protected securities like tips, or even commodities. These investments carry risks that cash doesn't, which is why education matters tremendously before diving in. But the risk of doing nothing while inflation eats your savings is often greater than the risk of prudent investing. Second, if you're employed, don't be passive about your compensation. In a high inflation environment, accepting the same 3% annual raise you got during low inflation years means accepting a real pay cut. Workers who switched jobs during the 2021 to 2023 period often saw wage gains of 10 to 20%, while those who stayed put averaged increases closer to 4 or 5%. Third, consider your debt strategically. In inflationary times, fixed-rate debt becomes more manageable over time, while your wages and assets may inflate. However, taking on debt specifically to beat inflation is dangerous and should only be done with expert guidance. There's a bitter irony in how this silent tax gets discussed in political and media circles. When governments need money for programs or infrastructure, the debate over raising taxes becomes fierce and public. Politicians grandstand. Economists write op-eds. Citizens call their representatives. The democratic process, however messy, at least functions. But when that same government finances spending through money, creation, and inflation, imposing costs on citizens that exceed what any realistic tax increase would charge, the process happens quietly in meetings of central bankers and treasury officials that most Americans never hear about. There's no vote, no public input, just your wealth slowly draining away while official statements assure you that everything is under control, that inflation is transitory, that your concerns about rising prices are overblown. By the time the damage becomes undeniable, it's already done. The average American family lost thousands of dollars in purchasing power during the 2021 to 2023 inflation surge. That wealth didn't vanish into thin air. It was transferred, redistributed to debtors and asset holders, and, significantly, to a government that desperately needed revenue but didn't want the political cost of explicitly raising taxes. Looking forward, what should Americans expect? As of late 2025, inflation has cooled considerably from its 2022 peak, settling closer to the Federal Reserve's 2% target. That's encouraging, but here's what history teaches us. Once you've experienced a major inflationary episode, you don't automatically recover what you lost. If prices rose 22% over 4 years, and then inflation returns to 2% annually, those prices don't come back down. They just stop rising as quickly. You're permanently poor unless your wages or assets make up the difference. Furthermore, the underlying conditions that created the recent inflation surge haven't fundamentally changed. Government debt levels remain extraordinarily high. Political pressure exists to maintain spending without raising taxes explicitly. If another crisis emerges, whether it's a pandemic, a war, or a financial collapse, the playbook is clear. Massive spending financed by borrowing and money creation, which means another round of this silent tax. If there's one thing you should take away from understanding this silent tax, it's this. Financial literacy and engagement matter more than ever. The old advice that worked for previous generations, save diligently in a bank account, trust that your employer will take care of you, assume government policies will protect your interests, no longer holds in an era of chronic inflation and fiscal irresponsibility. You need to educate yourself about how money actually works, how inflation affects different asset classes, and how to structure your finances defensively. You need to vote not just based on campaign promises, but based on actual fiscal policies and their long-term consequences. And perhaps most importantly, you need to recognize that the silent tax isn't some unfortunate accident or uncontrollable force of nature. It's a choice. A choice made by policymakers who decided it was easier to inflate away problems than to make hard decisions about spending and taxation. Every time you notice that your grocery bill has climbed, or your rent has jumped, or your retirement savings aren't growing like they should, remember, this isn't happening to you. It's being done to you. The question is whether you're going to recognize it, protect yourself as best you can, and demand better, or whether you'll just keep wondering why. Despite working harder than ever, you seem to be getting poorer every year. Of course, this information is for educational purposes. Always consult a financial advisor before making significant investment or financial planning decisions.